Venture capital (VC) is a form of private equity investment where venture capitalists provide funding to early-stage startups or growing companies in exchange for equity or ownership stakes in the business. Venture capital plays a critical role in helping innovative companies scale and succeed, especially those that may not yet have access to traditional financing like bank loans. Venture capitalists are typically professional investors who manage pooled funds from individuals, corporations, or institutions. These funds are specifically allocated to high-risk, high-reward investments in industries like technology, healthcare, or fintech. For example, early investors in companies like Facebook, Airbnb, or Tesla were venture capitalists who provided the financial support needed to fuel their growth. The VC process starts with startups pitching their ideas or businesses to venture capital firms. If the venture capitalists see potential for significant returns, they invest funds in exchange for equity and often a say in company decisions. For instance, a VC firm might invest $2 million in a startup for a 20% ownership stake, betting that the company's valuation will grow exponentially in the future. Venture capital investments are made in rounds, such as seed funding, Series A, Series B, and beyond. Early rounds focus on building the product or proving the business model, while later rounds support scaling operations and market expansion. For example, a Series A round might raise funds to develop a product prototype, while a Series B round helps scale production and marketing efforts. In addition to funding, venture capitalists provide expertise, mentorship, and connections. They help startups refine their strategies, hire key talent, and navigate challenges. For instance, a VC with experience in the tech industry might guide a software startup on product development or introduce them to potential partners or customers. Venture capital is a high-risk, high-reward endeavor. Many startups fail, resulting in losses for investors. However, the few that succeed can deliver outsized returns. For example, a $1 million investment in a startup that grows into a billion-dollar company can yield massive profits. VC firms typically aim for an exit, where they sell their stake in the company for a profit. This can happen through an initial public offering, IPO, where the company goes public, or an acquisition, where the company is bought by another business. For example, venture capitalists who invested early in Uber saw significant returns when the company went public. While venture capital provides significant funding and support, it often comes with trade-offs for entrepreneurs. Giving up equity means sharing ownership and decision-making power. Entrepreneurs need to ensure their goals align with those of the venture capitalists to maintain a productive partnership. In summary, venture capital is a funding mechanism where investors provide capital, expertise, and support to high-potential startups in exchange for equity. It drives innovation and economic growth by backing companies that shape the future, but it also carries high risks for both investors and entrepreneurs. By fostering collaboration and scaling businesses, venture capital remains a cornerstone of the startup ecosystem.